Question 30 is a foreign exchange question. So here it tells us that on 31st of March 2004, LM sells €1 million of goods to PQ on credit. LM uses the dollar as their functional currency, so everything needs to be translated back into dollars, and has a 30th of June year end. So we're then given exchange rates at the date of the initial transaction, 31st of March, at the year end, 30th of June, and also at 31st of July, because it goes on to tell us that the balance for that invoice was actually settled on 31st of July. What we want to do is see how this would be reflected, and specifically what we need to calculate is what we would do as an initial recognition, so debiting our receivables and crediting revenue with the sale, and then what needs to be retranslated at the year end in terms of any loss to be recognised and how that reduces our receivables balance. So initial recognition, 31st of March X4, would be calculated by taking our €1 million and dividing those by the 0.74 exchange rate at that date, which here would give us a dollars amount of 1351351. The receivables balance is still outstanding at the year end, and as a monetary item does need to be retranslated. It's only non-monetary items which are not retranslated, so inventory, non-current assets. So at 30th of June X4, that same €1 million needs to be retranslated using the revised exchange rate of 0.77, which here would give us a figure of 1298701. So that at the year end, we would have to record an exchange loss of the difference between those two figures of 52,650. So in terms of selecting our answers, we would need to show 1351351 as the amount to be recognised when the sale is initially made, and then our loss to be recognised in our statement of profit or loss would be 52,650, and we would actually go and reduce the value of the receivable to appear in the SFP for that same figure.